Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence. Eric hosts the Trillions podcast with Joel Weber and the ETF IQ show on Bloomberg TV with Scarlett Fu. Today we'll recap the year 2020 for ETFs and also highlight some of the areas to watch in 2021. Eric, welcome. Thanks for joining us today.
Great to be here. Thank you for having me.
So 2020 has been a year like no other, and most of us would like to forget it. But it was quite an unforgettable year for the stock market and the ETF industry. It was a record year for inflows and a record year for mutual fund outflows. So talk to us a little bit about this trend. And we have seen this trend over the past few years because investors love ETFs because they are more cost efficient and more tax efficient. So we have seen mutual funds bleeding assets and ETFs gaining assets. So talk to us more about that.
Yeah, I mean, you've got, obviously different areas of the market that get popular. And so the flows can be outsized in one area and lacking in the other. But overall, there's a baseline of secular flows that kind of are moving from the mutual fund structure to ETFs. So this year was a record swing from mutual funds to ETFs of about $500 billion into ETFs. What made that swing unique this year is that normally mutual funds, their outflows are offset by the index mutual funds, right? A lot of the money leaves active, but there's still Vanguard index funds that take in money. But index mutual funds lost flows this year too. That's not normal. And so that's why you had one of the reasons you had the biggest swing ever. I don't know, I still pretty bullish on index mutual funds. I think they're big in 401k plans and I don't see them going away. But this year, Vanguard had some of the ETF share classes of their index mutual funds were a little cheaper. So some of the investors were able to migrate over. And so that was one of the reasons for that. But overall, look, you've got the ETF value proposition is really strong. I mean, I just how I put it to people. I'm like, they're dirt cheap, they are liquid, and they are tax efficient. Those are three biggies. There's some other benefits as you get down there, the ability to short them if you're trading, the transparency. You've got the just ease in which you can do asset allocation. They're available on all the platforms. There's a lot of little ancillary, but the bottom line, cheap, liquid, tax efficient. And that, that overwhelms a lot of other fund types. And so I don't really see this slowing down. We're, again, very bullish. There's a couple little things coming up in the future that I would say could be headwinds, but largely speaking, we see maybe about another $500 billion next year, maybe $600 billion if the big active legacy mutual funds start to put some more of their money and capital into the industry.
So we recently heard that Dimensional Fund Advisors is planning to convert 6 of their tax-managed mutual funds with over $20 billion in assets into ETFs. And do you think that trend will also accelerate next year, more mutual fund conversion into ETFs? And as far as talking about the ETF inflows, do you think equity ETFs will be more popular with investors next year or bond ETFs? Do you have any, ideas?
Yeah. Good. Okay. So for the bond and equity, it's tough. I think I have to go with equity. I think equity tends to just rule the land. I mean, it's so much bigger. The stock market is doing so well. I think also remember bonds, a lot of the treasuries are now negative in real yield terms, after you adjust for inflation. So that could limit them a little, but they had their record year this year. And this is after a lot of trading volume in March. They really underwent a lot of pressure, and I think they did fine. But they had some of their prices trade lower than the NAV, although the NAVs were stale. But largely speaking, bond ETFs had a big year. I think the Fed buying bond ETFs as part of their program to give liquidity to the markets was a major endorsement. But again, the thing with fixed income ETFs is the same. They're cheap, they're liquid, and they're tax efficient. The liquidity part, to me, is even more compelling of a feature than in the equity side, because bonds don't trade like stocks. There's not that price transparency. So to me, the fixed income ETF really has capitalized on the hunger and thirst for an electronic trade exchange for bonds. So the equity is already traded on exchanges. So I think the liquidity is even more potent on the ETF side. So what we find is the volume is actually growing tremendously, and then so are the assets. So I still think though equity is just such a bigger deal when it comes to fund investing for now. Also, fixed income active mutual funds, unlike their stock picking brothers or siblings, are doing much better in terms of retaining flows. There isn't that bloodbath of outflows out of fixed income active mutual funds. I think because advisors tend to appreciate the bond manager and the fact that there's a time element of bond investing, and a lot of the bond managers can beat the ag pretty easily. Although in March they underperformed it a lot because, again, they're taking on a little more risk. But until there's a severe long underperformance of active fixed income, that will inhibit fixed income ETF growth to a degree, because you won't see the people bailing on you won't have as much as the active to passive move as you're seeing in equities, where there really is not a lot of love for active management on the equity side. So it's interesting. They're two different worlds, and they're kind of benefiting from different things. But ultimately, again, it comes down to that value proposition. It's just hard to, look, I mean, Amazon, great value proposition. People love it and they use it. It's the same thing in any other business. And I just think ETFs really serve that up.
So let's talk about some of the top performing areas of 2020. Solar and clean energy ETFs did very well again this year, and that was after a phenomenal performance in 2019. Then all work from home beneficiaries, the trends which have been accelerated by the health crisis, internet ETFs, cloud computing ETFs, cybersecurity ETFs, video gaming ETFs, they did very well. And of course, ARK ETFs, some of the ARK ETFs did very well. And we will talk about ARK ETFs in a bit more detail a little later. But talk to us about the other best performing areas of 2020. And do you think these areas will continue to do well in 2021 as well?
I'd be cautious. Something like TAN, which is the best performing ETF of the year, is up big. And it's interesting. TAN will have taken the performance crown 2 years in a row. That's never happened. That said, if you do a 10-year chart on TAN, if you go back to inception, TAN was launched in, let me tell you here, 2008. So not a great launch date, but it's still down 56% since inception. And if we take 2008 out of the equation and we start at the end of 2008 to give it a break, it's only up 34% since inception. That's a 2% annual return. So TAN had a lot of room to make up. So I think you got to remember this is, coming from a real low. The other thing I would say about TAN and clean energy is some of the bump came from, there's the Biden administration. They're going to do more with clean energy. Be careful, because during Obama's tenure, TAN basically was flat, returned nothing. And yet something like aerospace and defense and banks had great runs under Obama. That's exactly the opposite of the quote narrative that you would expect. So with these themes, you just got to be careful, especially ones like TAN where there's a concentrated number of holdings. So I hope and think people probably using these ETFs like hot sauce on a meal. I wouldn't, put all my equity allocation into TAN. But if you believe in the sector and you're in for the long term, you should be able to stomach, maybe if it has a horrible year next year, if you think over 5 or 10 years it will grow. But these tend to have really big years, and then they tend to have some tough years. That's just the nature, especially clean energy and TAN. Video games has been pretty consistent, more consistent. But again, a lot of these stocks are getting pretty frothy in their valuation. So I don't know. I'm one of those people who, just has a little caution. lately, especially because we're in a new decade. And I go back to the 2000s a lot. I've been thinking about the 2000s more and more because in that decade, you had, I believe, XLE was the best performing ETF. That's the energy ETF. You also had small cap value giving you 7% a year annually that decade, and the S&P gave you nothing. And I think it's just a reminder, what I just said sounds like impossible because we've just gone through 10 years of this sort of growth tech thing, and bull market. I just want to. Things change. Do you know what I mean? That's our theme in the next couple of years is just to be prepared for changing markets, because nothing lasts. And you go back just only 15 years, and it's a whole different environment than it is now. So that's one word of caution. That said, I'm pretty bullish on thematic ETFs in general to grow and take in some assets. I mean, they'll probably be niche always, but they're going to be a growing part of the ETF universe for years to come. And the reason for that is, to us, they're part of what we call new active. And you've had the stock picking discretionary manager from the 90s in the mutual fund. That was the real popular era then. And it's not like active went away. I think it's just changing forms to a degree where people are not interested in active that way, but they do want to go active with smart beta, things like minimum volatility, value, growth, or with themes. Themes is just another way to reorganize stocks into different weightings and try to do a little better or different than the benchmark. And I'd also throw ESG in there. To us, all of these are now competing over dollars that want to do something different than hold a Vanguard index fund. And there's definitely a good chunk of money that wants to do that. Right now, that area has about a quarter of all ETF assets. The other 75% rather is in what we call cheap beta for the most part. But that 25% is growing, and we're pretty bullish on that long term. And then that area will also include discretionary active. So there is a home for active. It's just it's not only the traditional active that you think of. And themes to us are just the new form of it. And largely, these new forms of active tend to be cheaper. They're tax efficient in the ETF wrapper. And some people like the fact that they have no motion. It's basically built on rules that, have their rebalances and reconstitutions, regardless of what's going on in the market. And that lack of emotion, some people like.
I totally agree with you on the outlook for thematic ETFs. And there are so many very interesting thematic ETFs available to investors now. And many of them are very cheap too. Now, let's talk about another area which has been very hot this year, but which doesn't have an ETF. Normally, you think of a theme or a niche, and there's an ETF for that. But Bitcoin, which is up more than 200% this. And over the past few years, several ETF providers have filed for Bitcoin and other crypto ETFs, and all those applications have been rejected by the SEC. And, most of us can buy and sell Bitcoin today on apps like Robinhood or Coinbase, or PayPal and Square have made it very easy to buy and sell Bitcoin. But people who want Bitcoin and other cryptocurrencies in their brokerage accounts, they don't have very good options. There's GBTC by Grayscale and a newer fund, BITW by Bitwise. The problem with these funds is that they usually trade at a premium to their NAVs, and that premium can sometimes be totally insane. So do you think we will finally get a Bitcoin ETF in 2021? And what are your thoughts on those two funds?
50-50 shot. I've just been burned too much to go more than that, but we've got a new administration coming in, so that's a huge variable. If it wasn't, I'd probably be more like 15-20%. The other thing is you've got more and more of these trusts that trade over the counter coming out, like from Bitwise, as you mentioned, and they're even showing off that the NAV and the price are so disconnected, almost as if to really just show the SEC, hey, this is crazy. And what's changed this year to me is there's basically way more assets in GBTC and ETHE, which is the Ethereum one. They're now like $17 billion. They were, I think, something like one or two tops, maybe even less at the beginning of the year. They've had a very ARK-esque rise as well. If it wasn't for ARK, I think this would be a bigger story, frankly. And the fact that they trade at between 30% and 300% premiums is potentially dangerous, because let's say like the Ethereum one is going to unlock some new shares. What that means is that if there's more shares to be sold by the people who own the trust initially, they might take profits on that high premium, and that will mean the premium will come down. Which means if you hold that thing, you're gonna see your price drop by maybe 20, 30, 40%, yet Ethereum, let's say it was flat. So that unnatural losses or gains we don't like. We think that's why people don't use closed-end funds as much anymore. We like to have the price next to the NAV. That's what makes ETFs so great. And, it's sort of like buying a car. You want the car to be bought for what is close to the Kelley Blue Book value. Same thing with, investment products. So that said, the demand for crypto is so amazing that people are still willing to do this. So I just, caution anybody that, you are getting in and you're bringing in this other variable and this other element of the premium. And you just got to know that. If you do, fine. But, just beware. Just beware. They're not ETFs. Sometimes they get referred to them as that. But ultimately, we get a Bitcoin ETF. It's possible we see some of those premiums fall down a little as people might leave to go to the ETF. But on the flip side, the price of Bitcoin and crypto in general could go up dramatically, because everyone's going to get more bullish because, hey, now there's ETFs. This will expand the audience for crypto. So it's possible that the premium collapsing and the price of Bitcoin, are wash each other out, and it's not that big of a deal. I don't know. But these are all just, open questions and just things to watch out for. But I will say that, bottom line, clearly there is a market to buy Bitcoin in something that is other than direct buying Bitcoin. And that's ultimately what the SEC's got to sort of, work through. And, if they approve an ETF, I would see it going to 20 billion within a year.
I totally agree with that. It would be one of the biggest ETFs very soon. Now, since you mentioned ARK, let's talk about ARK ETFs now. So if we look at the top 10 best performing ETFs of 2020, there are at least 3 ARK ETFs in there. And, normally people say, oh, Tesla was mainly responsible for ARK's ETF's excellent performance. But ARKK and ARKW, which have Tesla as their top holding, that they did very well this year. But ARK's best performing ETF was the genomics ETF, ARKG. And investors love good performance. They love to chase performance. So as a result of phenomenal performance of ARK ETFs, a lot of funds have flowed into ARK funds. So talk to us more about ARK ETFs, and do you see their excellent performance continuing going forward too?
This is probably the story of the year, especially after March has become pretty much of a distant memory. In March, obviously, the sell-off in bond ETFs were ruling the coverage. But lately, it's been ARK. It's all ARK every day. And it's getting bigger and bigger. I've been watching the volume. And now these funds, as a group, there's 5 of them. There's 5 main ones, are now trading over $2 billion a day. And most of that isn't like the way gold GLD trades or the way XLF trades, where people are just buying and selling because it's a way to quickly get liquid exposure to an area. This is mostly volume from just the stampede of buy orders. And that's really, you rarely see that. So about 50% of the volume is converting into flows. So it looks like she's going to, our Kathy is going to take in about close to $1 billion a day for the foreseeable future. This is an astonishing amount, considering she only had about $1 billion at the beginning of the year. So there's a couple issues here. First, history is littered with hotshot managers that have a fall after this kind of a run. Will that happen? I don't know. I just know history points that direction. The other thing is, when you think about these kind of crazes, remember currency hedging was very big back in 2013, and DXJ also grew to about 18 billion. That's where ARKK is right now. DXJ has $1 billion today. Now, people have more of an emotional connection with Kathy. That might help if she stumbles in performance. I don't know, but we've seen that story too. Now, the other thing is, I think when you look at ARK, the problem they might have with getting so big is capacity where they used to own like 13% in small caps, for example, in the flagship fund. That's like down to 2% now. Some of the stocks now, she's like or ARK owns more than 10% of the shares out. So you're going to move the market. You're now going to have impact costs. And, I'm not sure she wants to be that big of an owner. So it's very possible she's going to have to just adapt to being like a large cap manager for the time being. It's possible outside that she closes new creations, which would make her trade like that GBTC fund we talked about earlier, which is not ideal, but it's happened. GDXJ went through this a couple of years ago where it became too big for the junior gold miners. I don't know what's going to happen. That's why I'm tracking it every day. And it just seems to get bigger and bigger. I'm looking today, and it looks like the volume is probably going to surpass the volume yesterday of 2.3 billion, probably looking at 2.5, 2.6 billion. It just seems like the more that the flows come in, the more flows come in. And it's wild. It's crazy too, considering that she's active, the stock picking, which is so out of favor. She's high cost, 75 basis points is like way beyond the asset weighted average ETF fee. And she's indie. It's not like BlackRock or Vanguard doing this. If you told me you have one of those things, I would say your life in the ETF world is going to be very difficult. She has all three of those things, and she's had the success. The whole thing's it's like a one in a million situation.
Right. It is definitely one of the biggest ETF stories of 2020. So ARK ETFs and Kathy Wood, they are not afraid to disclose their daily holdings. They don't worry about possible front running of trading ideas. But there is another class of ETFs who do not want to disclose their holdings daily. And last year, the SEC approved this structure, the active non-transparent category, also known as the ANS. So these fund managers don't have to disclose their holdings daily. And we saw some of these products launch this year. They haven't gathered a lot of assets yet, but there are still new products, and issuers are launching more products. Invesco just launched 4 new active non-transparent ETFs. What are your thoughts on asset growth in this category next year? Do you think these products will gain traction next year?
Yeah, here's my take on that. Organically, this is a tough road ahead for the ants, because we have found that one of the governing laws of the ETF world is almost all the money goes to dirt cheap or shiny objects. And the ants are neither of those things. They're not taking big bets and concentrated portfolios like Kathy, although some have a decent amount of active share, but not like that. And it's just not their nature. They're much more conservative active, looking for good risk-adjusted returns. But they also charge between 40 and 60 basis points. So they're not dirt cheap by any means. So it almost feels like they're caught in the middle. They're not one or the other. And I see that as a dead zone, no man's land, organically. I also wonder if you get a second bite at the apple. We have been this issue of, will investors give you another look if they were turned off from you in the past? Because think of DXJ, which I mentioned earlier, currency hedging. After the currency hedging strategies stopped working, people left. But then it started working again. It outperformed for about an 18-month period pretty well. Nobody cared. And I don't know if you get that second bite. That's one thing I worry about ARK. If they stumble, it's tough to get it back going. It's almost like once bitten, twice shy. And the ants could suffer from a little of that second bite issue. The thing they have going for them is they're huge. And I think we could see some surprises next year, like DFA announcing a $28 billion conversion from mutual funds to ETFs. We could see them maybe do a, quote, BYOA move into one of the ants to get it going. These are massive companies with a lot of revenue. So our take on this is organically it's going to be tough, but look for them to surprise you next year. So we're expecting about $100 billion in what we call big active assets coming over. So we already have $28 billion known from DFA, maybe a couple other billion from those known conversions. That leaves about $60 billion. We think they're going to surprise us It's hard to say exactly how or when, but I think they're going to look at the flows this year, look at everything going on, and realize they have to start to use some of their capital to create a scene in their own ETFs. So that's my take on it. But organically, they're just in a tough place. And then throw in a lack of a track record, and it gets even harder. So I don't envy the work cut out for them. That said, they've got what they do have going for them is just an arsenal of assets and money in their mutual funds.
Yeah, definitely. That's an area we'll be watching in 2021. Now, another area which has been very popular this year and last few years as well is ESG or sustainable investing. And this year, a record more than 27 billion flowed into ESG ETFs. And in fact, ESG ETFs have done very well this year too, and last year as well. And that is because they have a lot of exposure to technology. Do you think this trend of sustainable investing will accelerate further under a Biden administration, and the area would see additional asset growth?
Possibly. Again, as I said earlier, if tech continues to do well, ESG will do well. Tech and ESG's fate are connected. There's two things of ESG. There's the people who go in want to sleep better at night. If you're really hardcore ESG and you don't shop at Amazon because of the way they treat workers and you drive an electric vehicle, I think those are the people who are really the true ESG audience, because they're going to be able to stomach potential periods of underperformance. I worry about the people going in now seeing a little outperformance because tech has been beating up on energy, and most ESG ETFs are overweight tech, underweight energy, and it's in the news a lot. I worry about them going in and then, it doesn't always outperform. I didn't know that. Because if there's a reopening or a supply shock in oil, energy will outperform. Or let's say there's a tech sell-off. It's pretty high valuations in tech right now. ESG will probably underperform. And you have to accept that. The other part of ESG that's difficult is, some hold Amazon and Facebook because they want to be closer to the market, and some eliminate those kind of companies because they want to more be pure in their ESG-ness. And that's a big difference. And you have to decide if you want diet ESG or full-on ESG. And you can't tell from the names whether they're diet or full. And again, this gets very layered and confusing also because ESG is subjective. Some are going to have different criteria that you may care about and not care about. It's it's almost like four-dimensional. It's the hardest thing to try to analyze because I don't know you or your views. And so I also don't know, how you are as a consumer, but I do see ESG probably slowly building up. I think it's going to build up way less than the hype. I think that ESG will probably carve out 5% of the ETF assets, but that's it. But that's a good amount. That would be 200 billion in today's terms. I don't really see it growing beyond that. I think some people are like, oh, it's going to take over all our portfolios. I don't know, especially if there's a period of underperformance, like with currency hedging, and that's it. ESG is going to get that black eye, and it'll go and into the same category as all these other things that come up and are the flavor of the month. And then the people realize there's no holy grail.
Yes, and I agree that definition of ESG varies a lot. So for investors, it is important to look at the holdings and make sure that those holdings actually align with their beliefs. And in fact, I noticed that the top holding in the vegan ETF is Tesla now. So that was an interesting finding.
But wait, now, by the way, real quick.
Yes.
Aligning with your beliefs is an interesting question because you could believe that energy is bad, Exxon or whatever. And it's okay, I want an ETF that doesn't have Exxon. And then literally you buy that ETF, you walk out of your building and you drive your car to the gas station and fill up your tank because you want to take a road trip. Or you drive to the airport and then fly to Mexico for a vacation. Do people see the inconsistency there? I wonder. And so I call those people slacktivists. And those are the ones that will probably get shaked out if there's underperformance.
Very interesting. So this has been a record year for ETF launches too, and for closures as well. And looking at the closures, most of them just failed to attract enough assets, and that is why they were liquidated by their sponsors. And many of the closures were in the riskier areas of the market, leverage, inverse, ETNs, etc. And looking at the ETF launches, some of the new ETFs, they are from very interesting areas of the market, like telemedicine, sports betting, work from home ETFs, virus themed ETFs like germ and virus. Then there's a next gen 100 ETF, NASDAQ next gen 100 ETF by Invesco, and there's a SPAC ETF. So, what's your take on launches and closures this year, and which new ETFs you like the best?
Yeah, the closures are normal. There's always a healthy dose, but they got a little inflated this year to record levels because a lot of the exotics closed. In March, the volatility and the swings in the market were very difficult for leveraged ETFs to keep up and provide that daily leverage exposure. So a lot of them closed. A lot of the famous bad boy ETNs like TVIX and UWT closed. So we lost a lot of the sort of infamous gang of wild products. We call them rated R products. We lost them. And so a lot of the people worried about those kind of products, it kind of took care of itself. So the ETF's a much more plain vanilla and cleaner industry than it was at the beginning of the year. So people who are worried about that, I think they can take some comfort in that. And that's what caused the extra. I think 70 of those exotics closed this year. That's way higher than normal. And there's always just products that close. Like there was a bunch of currency hedge products that closed this year, as we talked about earlier, because that's kind of gone. And so that's just part of the deal. And then in launches, we saw, I think it was 255 launches. That's a healthy amount. I mean, that's a good amount for a year in which the market wasn't exactly like smooth and perfect. And some of the launches, I looked at the top 10 most successful list, of the rookies, and it's interesting. Like the JP Morgan mid cap is number one. That's a lot. That's a BYOA move. There's some buffer ETFs on there. There's a target date kind of or an asset allocation fund. There's nothing. Oh, iShares has one. I think it's the one of their treasury funds is on there. But besides that, there's not really any huge issuers. It's not like all BlackRock and Vanguard, like the regular flows. One that's on the top 5 that we like a lot, I think it's number the 6th in asset gathering this year of the new ones, is QQQJ. These are the on-deck circle for the stocks that are next up to go into the queues. So it's like more mid caps, and you got some healthcare companies in there, and that's a great launch. It makes so much sense in retrospect. I can't believe they didn't launch that earlier, especially with the Q success. So those are some that I think stick out to me. There was a couple theme ETFs that stuck out. I think the work from home was one that I didn't think would do as well as it did asset-wise, but people tended to really want to play that theme this year. But yeah, a lot of buffer ETFs, ants, work from home. Again, largely all the new launches are now active in one way or another. That cheap beta, it's all that white space is pretty taken. And even if and who wants to battle Vanguard at 2 basis points there anyway? So it's almost like a suicide mission to launch there.
Right. QQQJ is definitely a very interesting product, and it has done quite well. In fact, it's been out for maybe about 2 months or so, and it has gathered a lot of assets, and it is up about 25% or more than that. So definitely one to watch out for. And some of the new ETFs have very interesting ticker symbols. For example, this one by GlobalX, Data Center REIT and Digital Infrastructure ETF. Ticker symbol is VPN. And WFH, the Work From Home ETF by Direction. That's also pretty interesting. What is your favorite new ETF ticker symbol of 2020?
Mine has to be Germ. I think not only is it just a good, easy to remember ticker, but it, captured the year. I mean, Germ is the whole reason, we're kind of in all this mess.
Right.
It's interesting to me. It's also an interesting story This was one that was launched or filed maybe like 4 years ago, and they
Yes.
never launched it. And they had the right vision. But when they finally got this launched, they missed some of the huge uptick in some of these vaccine maker stocks. But if they'd been around a little earlier, I think Germ would have been a much bigger product. I also like Germ over the other one that launched called Virus, V-I-R-S. Virus has got like Netflix and Home Depot and stuff. It takes a very liberal, I don't know the word, watered down view of that trend.
Yes.
Germ to me goes after these virus companies and allows you to really get into this sector of the biotech world, this section of the biotech world. And it's more volatile, but anyway. So Germ to me resonated. And I don't know, to me, it kind of was sign of the times this year. That and WFH. I think those two tickers will define 2020 in a nutshell.
Right. So that's 2020. Looking ahead to 2021, what would be your top ETF picks for 2021 if you were to pick 2 or 3 ETFs?
Right. So we don't give investment recommendations. So this is not investment recommendation, but I will give you a couple that I'm looking at that I really am going to pull up their DES page over and over next year. One of those is DFAU. That's the DFA U.S. equity ETF that's actively managed but transparent. But it charges 12 basis points. And we have found one of the winning formulas for newcomers to the ETF world is to give a brand name at Vanguard fees. It worked for Goldman and GSLC. It's worked for iShares with ESGU. And the other criteria is to have a fund that's not Cathie Wood, but a very conservative active. Advisors tend to go and will pick those funds if the fee is at index fund levels. So DFAU to us is going to be an interesting one. If that takes off, maybe some of these ants feel they need to lower their fee or convert to transparent. I don't know. That's one to watch. Another one is VTI. I know this one is obvious, but after the S&P 500 adding Tesla really late, we think there could be some migration from the S&P 500 into the total market because VTI has held Tesla for 10 years. You just never have to worry about it. Plus, if there's a rotation from large to small, like we saw in November for a few weeks, you don't have to worry about that either. VTI is like regime change proof. It's also inclusion proof because it holds everything. And it's going to take in the most money this year. It took in the most money last year. And we think it could be the first ever ETF to three-peat in flows 3 years straight. And I think it's got the best shot to knock off SPY from being the biggest in asset-wise. And then another obscure one I'll throw in there is MSOS. This is the multi-state operator cannabis ETF. With cannabis getting more and more, open here in the U.S. and legal, these track only the U.S. cannabis makers, including multi-state operators, which are the ones that tend to pop most with U.S. And the U.S. market is so much bigger than Canada, yet most of the cannabis ETFs hold mostly Canada stocks because you really could. The MSOS just figured a way around that using swaps. So it was a clever move, but long story short, they're going to feel that pop when it works. And there's going to be some serious return dispersion in the cannabis ETFs in the years ahead. But MSOS to us seems like it's best positioned to capture the opening up of the market here in the U.S. So those would be 3, ranging from, boring to maybe a little more wild.
Definitely very interesting picks and worth keeping an eye on. And as far as cannabis is concerned, there has been a lot of dispersion and performance this year as well. So investors should look at the holdings and the performance and then decide which one they want to invest in. Now, an important question for you. I've been a fan of ETF IQ show, and it is currently on hiatus due to COVID, I understand. So when is it coming back?
Well, we hope it's coming back next year. The half-an-hour shows, we really want both. They require 2 teams of producers. And so until the office fully opens, probably not going to have a full ETF IQ. In the time being, though, there's 2 ways to get me for free. If you don't have a terminal, well, there's 3. Twitter. I do an ETF segment every Wednesday at 3:40 p.m. on Bloomberg TV. and our podcast called Trillions. So if you don't have a terminal and you want to kind of catch me and our team's work, those are 3 places to find us.
Excellent. That's all we have time for today. Eric, thanks again for joining us.
Thank you very much. It was fun.
Thanks for listening. If you want to learn more about these ETFs, please visit the ETF section of Zacks.com. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments or questions, please email podcast@Zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.